Hi everybody, Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. And we've all probably heard about the stock markets globally making new highs yet again and beating the longest streak of new highs ever, etc., etc. So this is what that looks like. But let's just kind of look a little bit beneath the surface.
This is just the Dow Jones?
That's
global
all.
index.
No, that's global. That's the global
index.
Dow Jones. Okay. Now, this graph is from Goldman Sachs, and it shows you declining earnings while the market is going up. We've talked about this before. It should be pretty clear that the markets are going up, and people are willing to, or mutual funds, pension funds, hedge funds, etc., are willing to pay more for stocks as their earnings go down. So why are they doing it? How are they doing it? Keeping in mind that stocks form a lot of the compensation for a lot of these the top of the corporate food chain. That's why they want the stock market to go up. Plus, when you open up your 401k statement, if everything looks okay. So we know we want them to stay in the markets. But take a look at this. I think this is interesting. This happens to be HSBC, but in reality, since the early 2000s when the market really started to crumble, even though nobody knew it, stock buybacks from corporations exploded. Now, look, there could be good reasons for stock buybacks, but this is really more about lifting the stock price. Their profits fell 62%, and they're announcing bigger stock buybacks. But look at this, okay? These are corporations that actually pay out and make sure, remember, below are the links so you can see these specifically, but these are corporations that pay out more in dividends than they earn. So in this low interest rate environment, number one, if they're paying a higher dividend, it can attract more people to it. But again, who really has the lion's share of the stock? It's the corporate executives. So that's another tool to push the stock price higher and reward those insiders and transfer wealth. This is from the Federal Reserve, and this is showing corporate debt. I mean, how long can a company pay out more in dividends than they earn? And how can they do that anyway? They could do it for a little while as long as they've got the cash, or they can borrow the cash to maintain this. So what happens when they take on debt? They buy back shares. They pay out more in dividends than their earnings. Who's really going to be left holding the bag? That's the question that you have to ask yourself. Because what we're also hearing, and remember, we've talked about the lack of liquidity. That's really about when a lot of people want to sell, who's going to buy? This is from Bloomberg, an article on the hedge funds, and look at on that bottom piece right here, where you're at the lowest level ever. And typically when that happens, you get a market correction. There are no buyers in this market. So I don't know if you're in it or not. Personally, I am not. In my opinion, it's a much safer place to be, on the sidelines, and then obviously in an undervalued asset, which is gold and silver as well. But now I also want to show you one thing, and I'm going to be talking more about this as time goes on because I don't think people understand the securitization process. Securitization is when they take something that's real and they turn it into a financial product. So today we're going to just look at what's happening in the auto industry. This blue line here where I've indicated it, and this is from a New York Fed report, okay? You can see that in that blue line during the crisis, it dropped dramatically, but look at where it is right now. So there are a whole lot more loans being put out by those with lower credit, okay? This is how that's divvied. Who's giving out those loans? Now, here's the problem, okay? The problem is that most of those loans are coming from the car manufacturers themselves. So we know, let's see, I'm going to read this. According to this report from the Federal Reserve of New York, the year-end shopping pushed vehicle loans to $1.16 trillion. Okay, why is that a problem? Because of this. This, again, from the Federal Reserve, shows you vehicle loans that have been securitized. Okay, in other words, turned into a financial product and sold to you in the form of mutual funds, etc. This is where we were in the crisis. This is where it is right now. Can you see the problem? We've got growing delinquencies that are 90 days plus. It's not the banks or even necessarily the motor companies or the auto companies that are going to take it on the chin. It's all the people that unknowingly, in their reach for yield in the current low interest rate environment, that have put these in to pension funds and mutual funds and ETFs and all of these different products. And nobody ever bothers to take the time to read the prospectus. What am I really holding my wealth in? We're going to talk a lot more about securitization. It's a really important part in here, and I want you to understand it. So that's my time for today. I hope you found it beneficial. Go ahead and subscribe to our YouTube channel. We'll let you know when we're doing the live events. Follow us on Twitter, like us on Facebook, call us at 888-696-4653. Bye-bye.